How to evaluate a company before buying its stocks. Here are the top 5 tips before evaluating an investment. If you're new to investing, don't worry, I'll break it down step by step. By the end of this video, you'll know exactly what to look for. Tip number 1, financial health. Check the company's financial health. Think of this like checking the vital signs of a person. You want to make sure the company is strong and stable. Here's what to look for. Revenue and earnings growth. This tells you if the company is making more money over time. For example, if a company's revenue grows from 1 million to 2 million in a year, that's a good sign. Profit margins. This shows how much profit the company keeps from its sales. A high profit margin means the company is efficient. For instance, if a company sells a product for 100 and makes 20 in profit, that's a 20% profit margin. Debt levels. Too much debt can be dangerous. Check the debt-to-equity ratio. If it's too high, the company might struggle to pay back what it owes. And don't forget cash flow. This is the money the company actually has on hand. A company with strong cash flow can pay its bills, invest in growth, and even give money back to shareholders. Tip number 2, competitive advantage, or what Warren Buffett calls a moat. A moat is like a protective barrier that keeps competitors away. Here are some examples. Strong brand. Think of Coca-Cola or Apple. People love these brands, and that gives them an edge. Proprietary technology. Companies like Tesla or Pfizer have unique technology or patents that others can't easily copy. Economies of scale. Big companies like Amazon can produce goods at a lower cost because they buy in bulk. A strong moat means the company can stay ahead of competitors for years to come. Tip number 3, industry and market positioning. Evaluate the industry and the company's position in it. Not all industries are created equal. Ask yourself, is the industry growing? For example, renewable energy is booming while traditional fossil fuels are slowing down. What's the company's market share? If a company controls a big chunk of the market, like Google does with search engines, that's a good sign. Are there high barriers to entry? If it's hard for new competitors to enter the market, the company is safer. For example, starting a new car company is really hard because of the costs and technology involved. Tip number 4, quality of management. A great company needs great leaders. Here's what to look for. Track record. Has the CEO and management team successfully led the company in the past? Transparency. Do they communicate clearly with shareholders and follow ethical practices? Vision. Do they have a clear plan for the future? For example, Elon Musk's vision for Tesla is to accelerate the world's transition to sustainable energy. Remember, even the best company can fail with poor leadership. So, do your homework. And while you're at it, if you're enjoying this video, give it a thumbs up and subscribe to Evergreen Report for more beginner-friendly investing advice. Tip number 5, valuation. Don't overpay. Even the best company can be a bad investment if you pay too much. Here's how to check if a stock is fairly priced. Price to earnings, PE ratio. This compares the stock price to the company's earnings. A lower PE ratio might mean the stock is a good deal. Price to book, PB ratio. This compares the stock price to the company's book value, what it's worth if it sold everything. A PB ratio below 1 could mean the stock is undervalued. Dividend yield. If the company pays dividends, check the yield. A high yield is nice, but make sure it's sustainable. Think of it like buying a car. You want to make sure you're getting a good deal for what you're paying. To recap, here are the 5 tips to evaluate a company before buying its stocks. Check the financial health. Look for a competitive advantage. Evaluate the industry and market position. Assess the quality of management. Make sure the stock is fairly priced. And here's a bonus tip. Always consider the bigger picture. Things like interest rates, inflation, and global events can affect the stock market, so keep an eye on the news too. That's it. What's your favorite metric when evaluating a stock? Thanks for watching, and I'll see you in the next one.